Hey, welcome everyone. Tom here from Park Avenue Trading. I want to welcome you to this video. Been thinking about kind of a series that I wanted to do for you guys. I'm going to do what's called Lessons and Stories from a Chief Trader. And on the line I have Ted, one of my clients in the Park Avenue Trading Room. If you like what you see, please like, subscribe, and don't forget to ring the bell. This way you get to see another lesson from a chief dealer. So Ted, how are you doing tonight?
Good, Tom. I appreciate your time. Thanks for having me on.
You're welcome, very, very much. So what do you got for me? You put me in the hot seat tonight. What do you got?
Well, you got me. This forex stuff is kind of addictive. You start getting into it, and you win a couple things, and then you're like, well, what else is out there? And so I start looking around and seeing different things. And so one thing I saw was this thing called, well, one is moving averages, and I'm not sure if I fully understand moving averages. But then there was a strategy where it was that the idea was that the price is going to move away from a mean, and then it wants to snap back. So the theory behind it, I think he said it was Martingale, where
Martingale Trading Strategy.
Yeah, so it would be like, oh, if I lost a little bit, then that's okay. I would then double what my original position was, and if I lost again, I would double it again, and then with the idea that it's going to snap back and the wins are going to overcome the losses. And I don't remember seeing that in any of your stuff, and I was wondering, have you tried that? Do you do that, and why or why not?
Okay, let's start with the Martingale strategy straight off the bat. First of all, the rule of trading is only losers add to losers. And that's not my saying. That's from Paul Tudor Jones, one of the greatest speculators of our time. So Paul Tudor Jones gave me the first lesson way back in the early 80s when I was listening to an interview where he said only losers add to losers. Now, Martingale trading strategies, let's look at the strategy itself, okay? So basically, you have a trade on, and let's say you're risking $1, and you're out of the money, and it's moving away from the mean, and you have an upper band, you have a mean, and you have a lower average. So you have three different moving averages. You could have, like, say a 20, a 10, and a 30, just for argument's sake. Okay, so you have like three different bands, and as the marketplace is moving down to the 10 moving average, what you're going to do is you're going to double your bet size. So now you're going to have 2 on to get back to the mean, which would only mean that you'd make back the 1 that you were losing. So you're risking an additional 1 to get back just to 1. Now, okay, so that's a 1-to-1 risk. Actually, we don't really have to move back to the mean. We have to move up somewhere closer to the mean for you to be able to escape at break even. But what generally occurs is that when you continue to risk more money in order to get back to just even. So on the next movement, you'd be basically betting 4 just to get back 1. So the amount that you're putting out into the marketplace just to kind of get even, if it doesn't come back and go much higher than the original mean, it's a losing proposition. Now, you have to also take into effect that the risk reward when you bet 1-to-1 in round 2 is like is like maybe 30%, 33% once you start, because you got to add, you're risking 1 plus you're putting on 2. So now you got 3 units just to get back 1 unit. Don't forget your initial position. So that position basically is under the water. So, as it keeps moving further away, you're going to have to keep betting more and more. And I hate to use the word bet in Forex or in any type of trading, because really it's not a bet. You should be looking for a low risk idea. And Martingale systems, they fail. Now,
I just want to clarify, because your system is trying to get 1 or 2 or maybe even 3 R on your risk. So you're looking at, okay, what are the likelihoods that I'm going to make that risk worthwhile? And so
you got exactly.
It completely destroys that proportion.
You got it exactly. I always tell you to focus on R value. What is the risk value that you're using? Okay, so if you have a 50 pip risk in something, that is your R value. That's 1R. So before you even take the trade, you should be looking at what is the probability of me getting at least 1R, 2R, 3R out of this trade. So we're always looking for R value. We're not looking for, you know, okay, 1-to-1. We'd like to get more than 1-to-1. Sometimes the market won't give us more than 1-to-1, which is okay. But what we're trying to do is we're trying to risk small in order to earn big. That's the key to trading. To risk small amount, low risk idea, and then earn big. That's it in a nutshell. When you're doing Martingale systems, they're doing some really bad things psychologically to you when you're playing with a Martingale system. You're reinforcing adding to losers in trading. And I'm going to say something, and it's quite interesting. It actually feels good to add to a loser. And you're saying, what? Why does it feel good? Because if you bought at a 150 even, when it goes down to 149.70, and the Martingale is saying to buy again, well, you're in love with that because, man, you bought at 150 thinking it was going up. So at 149.70, it's even better. It's a better price. You're thinking you're getting a bargain. But when it goes down further and you buy again, you're like, well, I love them at 150. I love them at 149.70. I got to love them at 149.50. And you buy again. And the market keeps moving away. Eventually, what's going to happen is it will come to a point where you'll get a I don't know. For me, if I'm taking a loss, I get like a red wave that comes from my chest that goes to the top of my bald head, and like steam comes out of my ears. That's the point I got to get out. I'm like, I can't. I mean, so I never liked being in behind the eight ball. I didn't like ever adding to losers because psychologically, although it felt good on the first one, felt really good on the second, by the time the third one came, it didn't feel right anymore. Matter of fact, it felt downright dangerous. In the beginning of my trading career, I did it without even knowing it was Martingale. I did it because I was stubborn. I did it because I was attached to my idea. And attachment is the cause of all suffering. Even the Buddha said that. Yeah. So you can't be attached to any idea in trading. You have to basically to flow with the marketplace. So Martingale is reinforcing bad habits, and then it's also basically what it's doing to you is forcing you to overtrade. Overtrading is the death of a novice trader. You shouldn't overtrade. Your main biggest positive edge that you have as a retail at-home trader is the ability not to trade. The ability to say, I don't know what's going on today, and not make a move until you find a low-risk idea that you can execute that's going to get you a multiple of R value, okay, and have a stop. So, you know, that's the key, and that's one thing people don't really understand is that their main edge is that they don't have to do anything. You know, as a bank trader, when I had to trade every day. I had to be involved every day. I had customers calling me. I had my treasurer behind me screaming like, you know, mach show. In German, that means make a show. I mean, it was insanity. It was a very high-pressure place to be. And, you know, it made me a better trader in the long run, but you don't have to do that as an at-home trader. So let's go over the market types. Okay, a Martingale system, if you really want to know about a Martingale system and you want to know about one that really failed, you look up long-term capital management. They were trading a mean revision system, which is what that guy was talking about. When you have three different moving averages, it's really called a mean reversion system. Everything's going to reverse back to the mean. You know, everything goes to the average. Well, long-term capital management was trading something very similar to that. Of course, it was very sophisticated, it was a multi-million-dollar quant that they had, and they blew up. And because when a marketplace changes, that's when the biggest losses occur. So a Martingale strategy may work in a sideways moving market, but it's not going to work when that marketplace changes from sideways to bear or sideways to bull, because you're going to get those huge spikes that you're going to keep adding to that are not going to turn around. They're going to keep going, or you're going to get the huge spike down that's going to keep going down, and you're going to be adding to it. Now, don't forget, you have your broker. Your broker is going to stop you out, because they're going to see that you're way out of the money, you added to a loser, you're increasing your risk, they're going to close the trade. And you're going to sit there and go, and they'll probably close the trade right when the thing turns around. That's the way it is. You know, but sometimes it doesn't turn around and they did you a favor. So I hope that basically gives you an idea of why I think that Martingale trading systems are no good. And you don't have to follow me. I mean, you can go and Google Martingale trading systems. You'll see a lot of stories of people that tried to do it and they blew up. And I'm just going to tell you, as a professional trader in 35 years, like Paul Tudor Jones said, only losers add to losers. You just don't do it. Anything else?
Well, yeah, it makes total sense. And it maybe leads into maybe what we can talk about next time is like the idea about you don't add to losers, but is there a strategy in adding to winners?
That is the key to trading.
But maybe that'll be the next video.
That's the magic key, being able to add to winners and how you add to winners. That's the only way you'll ever advance your trading account. And it also happens to be the most difficult thing for any human being to do. Hey, I hope that you enjoyed the video. And please leave some comments below. Tell me your experiences if you tried trading Martingale systems. Also, don't forget, like and subscribe. Hit the bell so you can see the next one of the series. And maybe you want to check out parkavenuetrading.com, get a free little ebook, and maybe even join the trading room. Look forward to seeing you on the other side. Cheers.